In 1929, America wasn't poor. It was overconfident. People didn't lose money because businesses failed. They lost money because debt met reality. The Roaring Twenties were fueled by easy credit. Stocks were bought with just 10% cash. Banks lent freely and speculated themselves. Everyone believed prices only moved one way. But productivity slowed, wages fell, rates rose, and when confidence cracked, margin calls forced selling. The crash wasn't fear-driven. It was leverage unwinding. Markets ignored fundamentals. Crowds followed price, not value. Risk wasn't volatility. Risk was borrowing to stay invested. When everyone is positioned for upside, there is no exit. The Great Depression wasn't just destruction. It was redistribution. Weak balance sheets were wiped out. Strong capital survived and acquired assets cheaply. Crashes don't end capitalism. They reset ownership. History doesn't repeat. Leverage does. The next crash won't ask if you're smart. It will ask, are you liquid? In 1987, investors believed computers removed risk. They trusted algorithms. They trusted formulas. What they didn't realize, everyone was programmed to sell at the same time. Institutions used portfolio insurance. When markets fell, computers sold futures automatically. Selling triggered more selling. Liquidity vanished within hours. There was no recession, no credit collapse, just automated exits with no buyers. The crash wasn't emotional. It was mechanical. Risk models assumed continuous liquidity. They assumed orderly markets. But crowded strategies don't unwind slowly. They break violently. Markets don't need bad news to crash. Only forced sellers. Black Monday didn't destroy capital. It transferred it. Rigid systems sold at the lows. Discretionary capital absorbed supply. Volatility punished automation and rewarded patience. Technology doesn't eliminate risk. It concentrates it. Every crash answers one question. Who can still buy when others must sell? In 2000, investors weren't buying businesses. They were buying stories. Clicks replaced cash flow. Growth replaced discipline. And valuation was dismissed as old thinking. Easy money flooded technology stocks. Companies went public with no profits, sometimes no revenue. Analysts justified prices with page views and future dominance. Capital chased momentum, not fundamentals. When growth slowed and funding dried up, reality returned instantly. The crash wasn't panic. It was valuation reasserting itself. Revenue is not earnings. Narratives don't pay dividends. Markets can ignore valuation, but never permanently. When expectations are extreme, even good companies collapse. The dot-com crash didn't kill technology. It killed weak business models. Capital rotated from hype to companies with cash flow, scale, and balance sheet strength. The survivors became giants. Bubbles don't burst because innovation fails. They burst because prices outrun reality. In every cycle, the winners are the same: profits, patience, and discipline. In 2008, investors believed risk was diversified. It wasn't. It was hidden. And when it surfaced, the entire system froze. Cheap credit fueled a housing boom. Mortgages were bundled, sliced, and labeled safe. Banks leveraged balance sheets to historic levels. Rating models assumed housing never falls nationally. When borrowers defaulted, trust vanished. Credit markets seized. The crash wasn't emotional. It was counterparty failure. Diversification doesn't work when everyone owns the same risk. Leverage magnifies small errors into systemic collapse. In crises, price is irrelevant. Liquidity is everything. 2008 destroyed weak balance sheets, but it rewarded those with capital and courage. Distressed assets, forced sales, generational valuations. The biggest fortunes are built when survival is prioritized over returns. Markets don't collapse from losses. They collapse when confidence disappears. In every crisis, one rule decides winners: never rely on borrowed stability.